Two people, same city, same salary, same bank. They both get their first real paycheck at 26. They both start saving responsibly. Automatic transfers, less eating out. Watching the savings account slowly grow. For years, they do everything right. Then, something changes. At 36, one of them owns a home and has options. The other is still saving, still watching the number rise, but still feeling financially stuck. Same habits, completely different outcomes. The difference was not discipline. It was what they did after saving. Because saving money is only the first step, not the entire game. The people who actually build wealth understand something most people never realize. Saving is preparation. Investing is what changes your life. Rule number 1. A savings account is not an investment. Keeping large amounts of money in savings long-term quietly loses purchasing power. If inflation grows faster than your savings interest rate, your money becomes weaker every year. This is the inflation trap. Your emergency fund belongs in savings. Everything else should eventually be working somewhere else. People confuse the feeling of safety with actual financial growth. They are not the same thing. Rule number 2. The cost of waiting is invisible. Imagine two investors. One starts investing at 25. The other waits until 35. Even if the second person invests for longer afterward, the early investor often finishes with more money. Why? Because compound interest rewards time more than intensity. Every year you delay investing has a hidden cost. And the dangerous part is that you do not feel it immediately. There is no bill for waiting. So people keep delaying until decades disappear. Rule number 3. Most people do not understand what an asset actually is. A real asset puts money into your pocket over time. Stocks, index funds, businesses, rental income. Many things people call assets are actually expenses. Cars lose value constantly. Boats cost money constantly. Even houses can behave more like expenses depending on how they are financed. Wealthy people focus on owning things that grow, not just things that look impressive. Rule number 4. Your income has limits. Your investments do not. You only have so many working hours in your life. But invested money keeps working without you. A portfolio growing 8% annually generates money while you sleep. That is the shift most people never fully understand. At some point, your money becomes another worker. And over time, it becomes a very powerful one. Rule number 5. Lifestyle inflation quietly destroys wealth. Income rises, spending rises with it. Better apartment, better car, more expensive habits. The dangerous part is how normal it feels. Most people increase their lifestyle faster than they increase their investments. The people who build wealth usually do the opposite. When income rises, they increase investments first. Then later, their lifestyle grows from the wealth itself, not only from their paycheck. Rule number 6. Relying on one income source is financially fragile. Most people depend entirely on their job. If that income disappears, everything immediately becomes stressful. Financially resilient people slowly build multiple streams over time. Investments, dividends, side income, businesses. You do not need 10 income streams, you simply need more than one. Because financial stability improves dramatically when your entire life is not hanging from a single paycheck. Rule number 7. High-interest debt and investing do not work well together. If your investments earn 8% annually while your credit card debt costs 20% annually, you are still losing money overall. Paying off expensive debt is one of the best guaranteed returns available. People misunderstand this because investing feels productive. Debt repayment feels boring. But mathematically, eliminating high-interest debt is often the smarter move first. Rule number 8. Most people focus on the wrong number. They focus on salary. But the number that actually changes your future is your investment rate. The percentage of income you keep and invest consistently. Someone earning $50,000 while investing aggressively can outperform someone earning twice as much while investing almost nothing. Income is visible. Wealth building usually is not. Rule number 9, the goal is not retirement. It is financial independence. Retirement is an age. Financial independence is a condition. It means your assets generate enough income to support your life without depending entirely on your labor. That timeline is personal, and it is built intentionally, not accidentally. Rule number 10. The biggest financial risk for most people is not investing. It is avoiding investing for 30 years. Playing it completely safe often creates the most dangerous long-term outcome: money that never meaningfully grows. Wealthy people do not avoid risk completely. They understand it. They protect emergency money. They invest long-term money intelligently. They think in decades, not weeks. Now remember those two people from the beginning. The person who built options did not earn dramatically more money. They simply stopped treating their savings account like the destination and started treating it like the launchpad. They invested consistently, reduced debt, increased investments when income increased. They understood one thing earlier than most people. Saving money is the beginning. Investing is what creates freedom.